Balance sheet account balances are used to track some important ratios concerned with working capital, the availability of funds and capitalization trends, the balance between equity and debt as capital sources for the organization. The first of these two major areas, working capital, involves a few important ratio tests. First and best known is the current ratio, which is a comparison between total current assets and total current liabilities. Both of these groupings of accounts relates to the availability and use of cash and cash equivalents within the next 12 months. The current ratio is a test of how well a company is able to pay its debts over the next 12 months. The current ratio is calculated by dividing current assets by current liabilities. Here is an example. A company reports that its current assets at the end of the year are $700,300 and that its liabilities are $412,000. What is the current ratio? Let's see this on a spreadsheet. Here is the spreadsheet, the current assets and current liabilities, and the ratio is pretty straightforward. Current assets divided by current liabilities. As a general observation, a current ratio of 2 or higher is a good sign indicating that liquidity is in good shape and that the company is able to fund its debts. A ratio below 1, meaning current assets are lower than current liabilities, is a warning sign, an indication that the level of working capital is a problem and that the company might have problems meeting its obligations in a timely manner. As with all ratios, the current ratio needs to be tracked over a period of quarters or years to see where the trend is headed. However, trying to accurately interpret the current ratio without analyzing its components can lead to problems. For example, if the company is carrying too much inventory or if it is accumulating accounts receivable without timely collections, the current ratio can appear healthy when in fact problems are emerging in managing working capital. So while the current ratio is a worthwhile test to perform, it does not tell the entire story. Because the current ratio is useful even with its shortcomings, especially as a long-term tracking device for working capital, keep it in your analytical arsenal. However, to best deal with the possible problems not revealed by the current ratio, you may also want to track the quick assets ratio, also called the acid test. And here is the formula: current assets minus inventory divided by current liabilities. Here is the example. A company reports that its current assets at the end of the year are $700,300, including $206,000 in inventory, and that its liabilities are $412,000. What is the quick assets ratio? Let's see this on a spreadsheet. On the spreadsheet, enter the values of current assets, inventory, and current liabilities. And the formula is current assets minus the inventory divided by current liabilities. And here we receive the ratio 1.2. With the exclusion of inventory, the quick assets ratio is expected as a general standard to reside at or above the level of 1. This adjustment is valuable in situations where the inventory level is going to vary greatly from one season to another. A retail operation, for example, is expected to have a very high inventory level at the end of the third quarter in anticipation of the holiday season, and then a very low inventory level at the end of the first quarter. Because these variations are caused by cyclical factors, not by changes in the business climate, the quick assets ratio can serve as a more reliable quarter-to-quarter predictor than the better-known current ratio. This ratio is also more reliable because inventory is not as easily converted to cash as other forms of current assets. Even when inventory is depleted through sales activity, it may be first converted to accounts receivable before cash is finally generated. These realities make the quick assets ratio a worthy accompaniment to the current ratio.